Good Tuesday morning. Everyone joining us for the first time. Thanks for coming by and checking out the Chameleon Free Market Show with this man, Mitch Argamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And as I'm sharing my screen, anyone join us for the first time, Will and I, we do these shows in the morning to help answer questions you may have about the Market Chameleon tools, the data, analytics. If you want to ask a question, you could type it into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also have a link to Zoom on that live chat. Click on that, go over to Zoom. Once you're in, click on raise your hand, and you could ask your question directly. While we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report to see if we could get some insights on what's trading in pre-market hours, and then we'll move on to the questions. Okay, so pre-market report, these are stocks trading in the pre-market hours. I'm going to scroll down here, and we have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. And here I see 133 stocks made our percentage gainers list, 36 on the decliners. So far from that perspective, it looks like we're setting up for a bullish bias at the open. Let's take another point of view from what's going on in pre-market hours. And up top, we have this calendar view. And this is broken down by different dates. Today, August 22nd, we see that there are 522 stocks trading higher than the previous day's close in the pre-market hours, 156 stocks trading lower. If we look at the volume of shares, we have 121 million shares trading on up volume versus 42.6 million on down volume. And if we convert those shares to dollar value, we have $3.8 billion worth of stock trading on up volume versus $418 million worth of stock trading on down volume. So this also indicates that the trading has, is a bullish sentiment in the morning. Okay, so far that's what's going on. One more thing will come down over here, back to our list. And if you look at this list here, you do see a lot of small cap stocks in there, ETFs, there could be preferred stocks, leverage products. And this is pretty much any security that's listed on a major US exchange. If it's trading in the pre-market hours and meets our volume, price, and liquidity thresholds, it can make this list. And to narrow down to a smaller group, you could use the filters here up top. If you have a watch list, you could filter by your watch list. I'm going to use this one in ETF. I'm going to click on it, and we get a drop-down menu with different ETFs to choose from. I'm going to select this one, SPY. That's the S&P 500 ETF. And then when we click on that, the list below gets filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we have 14 stocks that made our percentage gainers list, one on the decliners. And again, that confirms that so far the trading in the pre-market hours is setting up for a bullish sentiment in the morning. All right. So we gave it a couple minutes, Will. I guess I could go to the questions now.
Yeah, nothing's popped in for a question yet.
Okay. So we had a couple questions come through on the email. One, from Lauren. I'll take that question, especially he sent us a nice picture. He was on vacation and had a Market Chameleon shirt on. So thank you if he's out there right now listening. But
Yeah, actually, can I share my screen real quick? Is that possible?
yeah, you can share your screen.
You have two share, actually. That's Lauren. He sent that to us.
Yeah, that's awesome. Yeah,
which is
thank
very,
you.
very,
Yeah,
very cool. And then Chuck was talking about we were discussing Maui yesterday and how devastating these fires are. And he took a family trip one time and caught a record marlin, which he was nice enough to share the photo.
okay.
Cool. You see that?
Yeah. So can I share my screen, Bill?
Yeah.
Okay.
You able to share?
Yeah. All right. So let me take Lauren's question. It was a good question. Maybe let me see how to set it up. So, from the way I recall it is there a way to measure SPY and track, estimate or predict the price of SPY using other ETFs? Okay, and I think it was like the treasury ETF, the gold ETF, silver ETFs. So the kind of like, here, I'll set it up. And let's just say over here we have SPY price, right? And if we use, let's say, gold, TLT, I don't know, silver, I think there's oil ETFs. And the idea is, well, if we track the changes in prices of these, right? So let's just say, I think it's price changes. And if Lawrence there, he could correct me, is it, price changes? If these prices, if we could track these, can we predict the price of SPY? All right, and this would be maybe like you could do like a simple multi-regression. And try to get like a high correlation, R square, and track the errors. And I like so the thought process is good, because the idea is, well, if interest rates are moving, right, that should be impacting equity prices, right? If oil is moving, that's an input into production. It's a important commodity in, for consumers and transportation. How does that impact the price of the market, SPY, right? So can I track like a daily moves in one, and using those, can I predict that what the daily move would be in SPY? Okay. So here's my, without building the model, okay, without building this model fully out, and you could definitely test that, right? You can test it by saying, well, let me see the daily changes and running it through a multi-regression, or you could do it through a learning, like a learning model, and you could see, can I predict today's price change in SPY by using the price changes in these as inputs into my model. And before I do, and we could do that, my hunch would be that this would not produce good results. And the reason for that, I think, is that if we look at these ETFs, right, the ETFs themselves would not, this basket of ETFs would not be a substitute for SPY. So you couldn't create like a parity model through it. It's not like creating the NAV for SPY. You probably maybe even taking a basket, a subset of SPY, and doing a multi-regression would be better. And one of the reasons here, let me show you guys how when we run a valuation, let's say we run a valuation model. The valuation model itself would, I'm going to just draw it out. It would probably look more smoother like this. And let's just call that, these are valuation. So the valuations is our guideline. Okay. And then the prices, the actual prices will usually move around. The actual prices will move around much more than the valuations. So in other words, prices always are more volatile. The supply, demand, and the emotions are much more volatile than the valuation models. And if I had to choose this basket, if I chose this basket, the idea is, well, how much do, I think commodity prices and interest rates impact the SPY or S&P 500. And I'm showing you this because it's what these two variables, what you probably want to model is their impact, right? Their impact on earnings growth over a longer term. Right. So what is the impact of higher commodities on earnings growth, higher interest rates on earnings growth? And of course, interest rates we're using to discount all the future cash flows. So from day to day, even though oil prices could go up and down, it's already built into the models that oil prices are going to fluctuate. And daily oil prices, moving up or down 1% will not impact the earnings growth potential, the earnings growth forecast that much unless there's a huge shift. All right. So you'd almost have to put it into buckets. I would say if oil is trading between, the earnings growth, they're going to average it out, right? So for oil, I would say like they're just going to put it in buckets. If it's in between here and here, project this earnings growth. If it gets up to there and stays there, project a different earnings growth. Commodities as inputs, interest rates, they'll fluctuate, every day a little bit, but on long-term earnings growth, it smooths out. So I don't think that if you're looking at small changes from day to day in interest rates or oil or silver, because there's going to be volatility in them. I don't think that those small changes will have a high correlation or impact on the price of the S&P 500 index. So it's not the same thing as calculating the NAV, because the NAV is a direct relationship between the SPY price, right? The NAV and the price there's a direct relationship because you could create and redeem, ETF shares. So using these ETFs in specific, you could run a multi-regression, or you could just even run it through like a, I don't know, gradient boost model, see what it gives you. But I don't think that these variables, raw variables, will be a good day-to-day guide, as a model, day-to-day guide where SPY prices should be. Does that make sense for those reasons? So let me know if that, if I was answering the question. But that would be my thing. Now, if you took, for example, basket of commodities and your interest rates and some other variables, and you're able to say, well, if interest rates shift here, and if commodities shift to this level, what do I think that's going to impact future earnings, right? So we're looking at for 6 months from now, 1 year from now, 2 years from now, how do I think that's going to impact earnings? So if interest rates go up, cost of capital goes up, borrowing costs go up, what do I think how that's going to impact earnings in the S&P 500, right? How's that going to impact earnings growth? If you could project that out into the future, right? If you could look at history and project that out into the future, and discount it, then you could kind of see, okay, this is what I think it will impact the valuation, or as a whole. Same thing with commodities. If oil prices, I don't know, if oil prices go to 100, how does that impact, consumer behavior, consumption? How does that, spending, input prices into production? If you could figure that out and then project, how that, what impact that will have on earnings growth, then you could kind of tweak your valuation model. But again, like you see when we're talking about valuation models based on, earnings projections, those are very tough. But usually, the prices themselves will be much more volatile than your value, because if your valuation model is volatile, it's not a good model. You don't want it to jump around like stock prices, right? You want it to be more smoothed out. So I don't know, Will, if you have any other questions. You're on mute, Will. You're on mute.
Sorry about that. We did have some questions popped in.
Okay.
Area's asking, aren't these time series data where the order of observations is important? He's asking mostly because if you use a cross-sectional model, such as a multiple regression in this case, it will only end up with spurious predictions based on a look back time window.
Right,
That was from Area.
Right. So in this situation, all right, and by the way, that was the question. I'm not recommending to do this. In this situation, what you're doing is saying, well, can I, predict the price change in SPY using other features or variables, right? And which variables and features do you use, right? That's the question. So don't think of it when you say, I'm not sure if she's saying or he's saying time series, in the sense that you're trying to use SPY prices to predict future prices. That's not what's happening here. It's trying to say, is there a relationship between these variables and features that it could explain the price change in SPY? And you could run that multi-regression, right, to a simple multi-regression to see if there's a relationship, right? So that would be the test. Is there a strong relationship is the question. So a simple multi-regression, right? If you run a simple multi-regression, it will give you an R-square. It'll tell you the relationship. It'll give you a standard error. So you'll see right away, is there a strong relationship between this basket, these variables versus SPY. So that's what you're testing, right? The simple multi-regression would, because you could run a single regression, you could just say gold versus SPY to see how that works out. But when you start out with an analysis, you want to run the most simple models, because sometimes the simple models work. Sometimes a simple multi-regression works. Sometimes a single linear regression works. So, other times you might want to run a non-linear regression, which is a little bit more difficult to explain. Then you might want to use a learning model in there, like a gradient boost that uses, the tree decision trees. You may, but what is important, and maybe this is a good question. Actually, this is a very important question, because it's not so much the model, right? It's not like just throwing things in a model. It's preparing the data and cleaning the data, preparing the data. What data do you use? How do you structure the data is like 95% of it. Okay, that's probably 95%, because you can't just throw things into a multi-regression and hope it all just works out whatever you throw in there. So preparing the data, what data you use, how do you fill in, do you normalize the data? What do you do with missing data pieces? Which data do you use? It's all important in your model, right? And then how do you evaluate your model, right? Then how do you test it? How do you, there's ongoing evaluation, right? So even if you create a model with a high R-square, right, you need to test that model. If you're using a learning algorithm, learning model, you would need to create you'd have to separate the data into three pieces, right? You'd have your training data, your validation data, then you have your test data, right? So the training data, you get it, the model produces potential really high R-square. Then you have your validation data, where you're trying to set your hyperparameters. Then you have your test data to see, well, how does it actually perform? Does it perform as well as the training data? So like the models, the models are important, but also preparing the data. How do you want to even compare the data? Maybe a daily comparison is not good. Maybe you want to look at week to week comparison, right? Or if you're looking for a lag, you want to lag the data, right? So you're getting into a different type of model, where you want to see, well, what is the impact of it if there's a lag? So it's an important question, because we always question the data, what data are we using? How does our data set look? Even in a multi-regression, right? If in a simple multi-regression, you have a lot in there too, because then you have two variables that are highly correlated. What do you do with that? Do you take one out, and which one? So, yeah, as far as data manipulation is a good question, and that's what, data analyst does.
It was interesting, D. Rob was asking, is there an explanation on the site regarding regression analysis?
No, there's not specific to regression analysis. Now, some models will use it, right? So within our models, we will use it, but it's not specifically to teach like a regression model, multi-regression model. But those exist. You could go and look at those videos. You could run a multi-regression or a regression in Excel. So a regression, multi-regression, you could run all those in Excel. And the benefit of running them is that you do get the coefficients, so you could kind of explain the relationships, right? The harder ones are the learning models. Those are like the newest techniques to run predictors, and those are tougher to explain because it's a black box, right? So when you're running a model that has a black, you receive a code, and then you created this model, but you can't look inside to say, well, what is it doing? So those are harder to explain. But sometimes the easier ones work, right? Sometimes the simple linear regressions or multi-regressions, they're the best ones, because if they work, they're simpler and easier to work with.
That was an awesome explanation, D, and very helpful. Much appreciated. We're right up against the opening bell.
Yep. Well,
Last
thanks everyone.
Community.
Yep. Thanks everyone for joining. Hope stay safe out there. Hope you have a great trading day, and hope to see you guys tomorrow.
Thanks so much, D. Have a great day, everyone.